Imagine a company so powerful it didn't just trade electricity, it traded bandwidth, water, advertising time, even the weather. Wall Street called it brilliant. Fortune magazine named it America's most innovative company 6 years in a row. Employees became paper millionaires, and then, almost overnight, it collapsed. $74 billion in shareholder value vanished. 20,000 jobs disappeared, and one of the biggest accounting firms on Earth died with it. This is Enron, and it wasn't destroyed by bad business. It was destroyed by pretending losses didn't exist. Enron started boring. In 1985, Kenneth Lay merged two natural gas pipeline companies, just pipes, transporting gas, stable, predictable, forgettable. Then, the 1990s hit. Energy markets were deregulated. Suddenly, energy could be traded like stocks. Enter Jeff Skilling, Harvard MBA, McKinsey consultant, extremely confident. Skilling looked at Enron and said, "We're not a gas company, we're an information company." The idea was simple and intoxicating. Enron wouldn't just sell energy, it would create markets for everything. Wall Street loved it. The stock exploded. At its peak in 2000, Enron was worth nearly $70 billion. But behind the hype was a problem. The profits weren't real. Here's where things break. Normally, companies record revenue when they actually earn money. Enron didn't. They used something called mark-to-market accounting. Example, if Enron signed a 10-year energy contract, they would estimate the total profit for the next decade and record it immediately. Day one, before delivering anything, before collecting a dollar. On paper, profits skyrocketed. In reality, those profits were guesses, optimistic guesses. And when deals lost money, Enron didn't revise the books. They just booked new imaginary profits to cover the old ones. It worked as long as nobody asked where the cash was, but eventually, reality shows up. By the late 90s, losses were piling up, so Enron needed a place to hide them. They created hundreds of off-the-books entities called special purpose vehicles. These were supposed to be independent companies. They weren't. Enron sold bad assets to these entities at inflated prices, instant profit on Enron's books. Where did the SPVs get the money? From Enron. So Enron was selling assets to itself with its own money and calling it success. The architect was Andrew Fastow. He personally controlled some of these entities and paid himself millions. The board knew, they approved it, and the auditors signed off. Which brings us to the final accomplice. Arthur Andersen was one of the most respected accounting firms in the world. They audited Enron. They also consulted for Enron. In 1 year alone, Enron paid them over $50 million. When your client pays you more for consulting than auditing, independence becomes theoretical. When Enron started collapsing, Andersen employees shredded documents. They were later convicted. The conviction was overturned. The firm still died. In 2001, the market turned. Analysts asked a simple question: where's the cash? Jeff Skilling quit as CEO after 6 months. Kenneth Lay told employees everything was fine while selling his own shares. Losses were revealed. Earnings were restated. Credit ratings were downgraded. The stock fell from $90 to pennies. On December 2, 2001, Enron filed for bankruptcy. The illusion collapsed in weeks. Executives walked away with millions. Employees didn't. Over 20,000 people lost their jobs. Many lost their entire retirement savings locked into Enron stock. Arthur Andersen collapsed. 28,000 jobs gone. An entire system failed at once. Here's the real takeaway. Complexity is where fraud hides. If a company can't explain how it makes money in one sentence, run. Enron wasn't innovative, it was opaque, and opacity is not genius, it's a warning. For more wild corporate disasters, hit subscribe and stay skeptical.